Hey everyone, welcome back to Corporate Decoder, the place where we decode the sometimes strange, often confusing world of corporate filings. Today we're diving into a proxy statement, which might sound boring, but trust me, it's like peeking behind the curtain to see who's really pulling the strings at Aurora Innovation. Let's see what this report will tell us. This document is for Aurora Innovation's annual meeting of stockholders. Think of it as a roadmap for the meeting, telling stockholders what's on the agenda and how they can vote. It's like a school election, but with potentially billions of dollars at stake. The first order of business is electing directors. Chris Urmson, Sterling Anderson, and a new nominee, John Donahoe, are up for election to the board. Directors are like the school board, setting the overall direction for the company. Stockholders get to vote on who they want in these roles. It's interesting that Chris Urmson is both the CEO and chairman of the board. This means he has a lot of power. Some people think it's better to split these roles, so one person isn't both running the company day to day and also leading the board that's supposed to oversee him. It can create a conflict of interest if it's the same person, but the board thinks it is in good hands due to his long history at the company. Every company faces risks, and it's the board's job to oversee how those risks are managed. The board has committees that focus on different types of risk, like financial risk, compensation risk, and governance risk. This process ensures checks and balances. Here, Aurora talks about its commitment to communities, safety, and the environment. They're trying to paint a picture of a company that cares about more than just profits. For example, they want to invest in programs that will make roadways safer. They aim to revolutionize transportation by making roads safer, helping goods reach those who need them more efficiently, reducing pollution, and more effectively giving people more services. The board has to have independent directors. These are people who don't have close ties to the company's management, ensuring that they're looking out for the interests of all stockholders, not just the CEO. The board has determined that 6 of the 8 current directors and the new nominee are independent. This section confirms that the people on the compensation committee are independent. It means that the people deciding how much to pay the executives are not executives themselves, and they don't have weird relationships with other companies that would mess up their decision making. Here's where we see how much the non-employee directors get paid. They get an annual cash retainer plus stock awards. The stock awards are meant to align their interests with the stockholders, since the stock price goes up when the company does well. The chair of the audit committee makes $25,000 extra. That is not a lot of money for all their extra workload. Looking at the table, it looks like a member made almost $300K to be on the board. Not a bad side gig. This is the say on pay vote. Stockholders get to give an advisory, non-binding opinion on how much the top executives are getting paid. It's a chance for stockholders to voice their approval or disapproval of executive compensation. The audit committee is responsible for overseeing the company's financial reporting. They review their financial statements, discuss them with management and the outside auditors, and make sure everything is on the up and up. These are the folks actually running the company. The main people include Chris Urmson as CEO, David Madej as CFO, Asa Fisher as president, and Shelley Webb as chief legal officer. Now we get to the juicy part, how much the executives are making. This section explains the company's compensation philosophy and how it decides how much to pay its top people. They are given both cash and company stock to encourage success. The goal is to attract and keep talented executives, and also to link their pay to the company's performance, so everyone's working towards the same goals. They need to have a good culture and a good mission. It sounds like Aurora does most of the best practices for compensation, such as having independent folks decide CEO pay and not letting employees bet against the stock. The compensation committee has an outside consultant, Semler Brossi, to advise them. This helps ensure that the pay packages are fair and in line with what other companies are paying. Importantly, they kept executive-based salaries fairly similar year over year. We can confirm from the table that it is mostly static, with the CEO making $400,000 per year and then a few folks making $500K. Executives are also eligible for bonuses, which are tied to the company's performance. For 2024, the bonuses are linked to the company reaching certain goals. The bonus plan design changed to convert from cash to restricted stock units and extend the timing to determine the company multiplier to the second quarter of 2025. In March 2024, they granted stock options and restricted stock units to executives other than the CEO. These stock options increase in value as the company increases in value. This section explains what happens if an executive leaves the company, especially if there's a change in control, like a merger or acquisition. They're eligible for a salary severance plus value of healthcare coverage. One such executive, the president, could make almost $14 M if everything vests upon a change in control. New SEC rules now require a table showing how executive pay relates to company performance. You can see the relationship to compensation actually paid. You can also see at the end of the row under net income that the company is still losing money. Here is a graph which can give you a better idea how they're trending over time. This shows the ratio of the CEO's pay to the median employee's pay. For 2024, the CEO made about 1.71 times what the median employee made. This is the part where we get to see who really owns the company. We can see how many shares the executives, directors, and major stockholders own. It can be useful for figuring out who has the most influence. For example, Chris Urmson, the CEO, owns over a quarter of the company. Companies have to disclose any transactions with related parties like family members or other companies that executives are involved with. These transactions have to be fair to the company. Looking at the report, it sounds like the main related transactions involve purchases from Amazon, and they outsource their data labeling services to Uber. To prevent any funny business, the company has an audit committee that has to review and approve any related person transactions. Now, let's put this all together and see what it tells us about Aurora Innovation. It's clear this is a company that's still in the building phase. Key people are getting paid in accordance with their contribution, and most have large but reasonable compensations. What is concerning is their continued money loss, and a large amount of revenue still depends on related party transactions. In a better world, those numbers would be lower and more revenue from truly third-party businesses. If the current stock is a good buy, you have to see if their plans play out and result in profitability. Thanks for watching, and remember to hit that like button, leave a comment, and subscribe for more corporate deep dives.